All right, let's have a look at the effects of making extra repayments on your home loan. So we have a repayments calculator here. Let's put in an example home loan of $300,000 over the standard 30-year term. And let's call it an owner-occupied home loan. So we should be around about the 3.80 mark or thereabouts. Let's change our repayment frequency from monthly to weekly, and we're going to make the loan principal and interest, so we're paying down. So based on a $300,000 loan over 30 years at 3.8% per annum, the repayments are $322 per week, and this will take you 30 years to pay down your loan. Now, the bank wants you to take 30 years to pay down your loan, so they make a lot of interest. There's no reason for you to take 30 years to pay off your loan. Let's look at the effects of making a few extra repayments to bring that 30 years down. Our repayments at $322, let's bring that up to $350 a week. So let's go an extra $28 per week and see what effect that has. That's brought your total term down by 5 years, or nearly 5 years, just by making an extra $28 per week repayment. So not much extra. $28 is maybe 4 or 5 coffees for the week maybe, but that's knocked 5 years off your home loan. Now let's get a little bit more aggressive. Let's maybe make that $400 per week, which would be an extra $78 per week. And bang, we've knocked off an extra 10 years of the home loan just by making an extra $78 per week. Now we get carried away, we can start doing a few extra repayments on top of that, but let's be realistic. $78 is perhaps a fair bit per week for everyone to handle paying off their mortgage. The question then is, how do you do it? We'd suggest you try the following exercise. Get your transaction accounts, so the account that you use to take out all your general money, where your pay goes in and where you take out all your bills and your spendings. Print off 3 months worth of statements for that account. Now, I ask you to print them off, don't do it on the screen. So print them off so you sit there with it in front of you. Now for that 3 months, I basically want you to go down and circle any discretionary spending that you've made in the last 3 months. So discretionary spending might be coffees, it might be extra clothes, it might be going out on the town, going to the movies, alcohol, anything that fits in those categories that's discretionary spending. Circle them, and I want you to add up all those figures for the 3 months. Once you've added up that figure, then I want you to divide it by 3. So that's going to give you an average of the last 3 months of how much you're spending on discretionary spending. Now, once you've done that, that'll give you an idea of how much money you could possibly put extra onto the home loan. And in most cases, I will guarantee you that the $78 per week extra is not as bad as it looks once you see how much money is coming in and going back out on assorted things. So just by doing that, I would then suggest, if you can afford the extra money, increase your direct debit on your home loan. So if you are paying the $322, maybe up it to the $400 or whatever works for you, and then forget about it. So your home loan is going to start getting paid down extra. Ideally, you've got a redraw facility on your home loan, so all those extra repayments that you're making will be able to come out as a redraw if you need it, if there's an emergency. But if you can keep it in there, obviously the better, and that's going to pay your home loan down much quicker.